Union Budget 2026 is arriving at a tricky moment for investors. Markets are volatile, valuations are selective, and predicting short-term moves has become harder than ever. In this environment, patience, not speculation, is the real edge. And while Budget Day rarely triggers dramatic market swings, it does set the tone for investment decisions in the months that follow. So if you are a small investor, what should you actually track in Budget 2026? Let's break it down. India is still aiming for growth of over 7%, but global conditions remain uncertain and foreign investors are cautious. At the same time, domestic participation, especially SIP inflows, remains strong. That suggests Budget 2026 is likely to be incremental, predictable, and focused on execution rather than big surprises. For long-term investors, that is not necessarily bad news. Let's start with taxation, because this is where the budget affects household finances most directly. Income tax relief. Markets are watching for a higher exemption limit under the new tax regime, possible simplification of slabs. Even modest changes can lift disposable income and support consumption-linked sectors. Long-term capital gains tax. Any move to lower long-term capital gains tax or raise exemption thresholds directly improves post-tax returns on equities and mutual funds. Even if rates stay unchanged, clarity and stability matter for investor confidence. Savings and deductions. Watch for possible changes to Section 80C limits, NPS incentives, home loan interest deductions. These may not move markets overnight, but they shape saving and investing behavior over time. Gold taxation. Clarity around taxation of physical gold, gold ETFs, and digital gold is also important. Simpler, consistent rules reduce compliance hassles and avoid unpleasant surprises for retail investors. Next, track the spending priorities. Infrastructure and railways. Capital expenditure is expected to remain elevated, possibly in the 12 to 13 trillion rupees range. Execution here supports sectors such as cement, steel, capital goods, and engineering, but stock performance will depend on delivery, not just announcements. Green energy and electric mobility. Announcements around green hydrogen, battery storage, and EV charging infrastructure will be closely watched, especially for long-term themes. Defense. Growth expectations are already priced in for many defense stocks. What matters now is order execution and delivery timelines. Technology and AI. Incremental funding for digital public infrastructure and applied AI could support select companies, though this is likely to be gradual rather than dramatic. Export-oriented sectors. Textiles, food processing, and auto components may see targeted support to counter global trade pressures. This is the part many retail investors overlook, but it matters. Fiscal deficit target. Any slippage can push up bond yields and affect rate-sensitive stocks. Borrowing and divestment plans. Higher borrowing pressures bond markets, while PSU divestment announcements affect liquidity and select stocks. Corporate earning trajectory. Markets ultimately follow profits, not promises. What matters more than what is said is what actually happens. After Budget Day, keep an eye on actual capital expenditure execution, speed of project clearances, corporate earnings growth over the next 2 quarters, and stability in inflation, bond yields, and the rupee. These signals matter far more for portfolio returns than headline announcements. So how should small investors approach Budget 2026? Stay disciplined with long-term SIPs, avoid trying to time Budget Day trades, maintain diversification between equity and debt. Track sectors for execution, not just headlines. Budgets set direction, but wealth is built through consistency, not reaction. We will continue bringing you more explainers and analysis around Budget 2026. Stay tuned.